So let me start by thanking the organizers for putting our paper on this conference. As I was already introduced, I will only introduce my co-authors. This is joint work with Andrea Barbon, Andrea Buraschi, and Mathis Moerke. And you may notice that the title of the paper has changed. It has changed given that we have significantly increased the scope of this paper by not only looking at rebalancing flows from the option market, but also looking at rebalancing flows from leverage ETFs. So what do we try to accomplish in this paper? Well, in a nutshell, we study whether there is any impact, and if there is, so the amount, the magnitude of the impact of the rebalancing activities which originate from market makers in derivative markets on the price dynamics of single stocks towards the end of a trading day. So, market makers, they hold a risky portfolio, say of options, and they want to at least hedge their directional exposure that is embedded in these options, and they do so by trading actively and dynamically in the underlying stock. And we try to, gauge whether this rebalancing activity is large enough to have an impact on prices. What we find very briefly is that a 1 standard deviation increase in buying through option market makers at the close increases end of day returns by 0.7% of the regular standard deviation of returns in the last half hour of a trading day. Comparably, a 1 standard deviation increase in the buying through a leverage ETF market makers increases these returns by 2.7% of a standard deviation. So, economically, these effects are actually quite large. And we further can show by analyzing these effects a bit further that both rebalancing sources occur primarily end of day, but that there is some discretion that option market makers enjoy regarding the timing of the rebalancing flows. We find that both work through a non-informational channel, so they are driven mechanically. They are transitory, quickly reversed after at the next open, and the effect sizes are highly persistent over the time that we can study. All right, so to kind of set the stage and motivate what we're doing, what you see here is the intraday price path of Tesla on the 13th of December 2012. And what you see is that up until around 3:30, prices of Tesla have decreased significantly. Right? Tesla on this day lost more than 6.5% of its value. And then all of a sudden at 3:30, you see that prices rebound by more than 2%. What we have estimated is that on this day for Tesla, the amount of buying from option market makers that they have to do to rebalance their book in all of the options that they hold on Tesla was quite significant. And we attribute this to be the cause for this rebound at the close. Likewise, given that we do not only study one source of these rebalancing activities, but two from leverage ETFs and options, we can also kind of differentiate the two effects from one another. What we see here is Amazon, and up until 3:30, the stock has lost more than 3% on this day. What we see afterwards is that prices rebounded quite heavily, which we attribute to the activity of option market makers buying into the stock to stay delta neutral. And then at 3:50-ish, we see that the stock declined quite heavily, which we attribute to the activity of market makers in the leverage ETF space, which, as we have estimated, would have to sell units of Amazon to stay neutral in their directional exposure here. All right. We are, of course, not the first study that is looking at these effects. For example, Neil Pearson and Peteshman have recently published a paper in the RFS where they study, whether these imbalances that arise from option market makers rebalancing their directional exposure have an impact on next day volatility. And Barbon and Buraschi look at a similar phenomenon, but intradaily, and they actually link these rebalancing activities of market makers in the option space to the presence of flash crashes. On the other hand, Shum et al. Have studied similar phenomena for end-of-day volume and volatility that can be altered or impacted by the rebalancing activity of market makers in the leveraged ETF space. Now, we add to this in a few important ways. First of all, instead of focusing on volume or volatility, we focus on order flow and returns by assuming that hedging takes place at a certain time. which we assume is end of day, so in the last 30 minutes, and we will investigate this a bit further. We can also differentiate between multiple sources of rebalancing, right? Is it worthwhile knowing whether market makers will buy or sell the underlying stock to stay delta neutral when investigating the impact of rebalancing activity from leveraged ETF market makers? And lastly, we can analyze the nature and the structure of these rebalancing flows and kind of provide a bit more of an intuition as to what they actually relate to. Now, we of course also relate to the literature on intraday effects, but for the sake of time, I will skip this one. Now, I've already talked about that we have to make an assumption about when these rebalancing flows actually take place. Why? Well, we want to look at the impact on returns. How do prices change because of these rebalancing activities? And for this, we kind of need to pin down the period in which most of the hedging takes place. And our assumption is that for option market makers, they will try to establish the delta neutrality towards the end of the trading day. And there are actually good reasons for this from the literature. The conditions at the close are generally favorable. We have high liquidity, low spreads, and generally a high market depth. And the closer to the close, market makers rebalance their books so they are delta neutral, well, the more they are protected against overnight or gap risks. Also, holding risky positions overnight, of course, incurs higher capital needs. And studies have shown that even in the presence of jumps, right, large price movements, it might be optimal to only hedge it partially. And we argue that this partial hedge is then offset at the end of the trading day to kind of pick up on these favorable conditions. For leveraged ETFs, this is actually a bit simpler. They are mandated to provide their multiple exposure at the close. So it's very likely that most of the rebalancing activity here will actually take place at the close. Now, given these considerations, we basically divide our trading day in two, right? The split occurs at 3:30, 30 minutes before the close. And we consider the return from the previous day's close up until 3:30 today, and the return from 3:30 today up until the market close. This is what we try to explain. This is what we try to relate the rebalancing flows to. Now, we also have a look at a third period here, which is the overnight return, well, up until 10 a.m., so a bit more than the overnight return, where we try to investigate how transitory, how quickly reversed are any effects that we might observe on end of day prices. Now, I will talk you through the case of delta hedging and to kind of understand how we come up with a proxy for these rebalancing flows. For leveraged ETFs, it's kind of similar, but it would be a bit too much for the brevity of the talk. So I will restrict myself to delta hedging here. So assume that you are a market maker. How do you manage or mitigate your directional exposure? Well, you dynamically trade in the underlying, right? Delta hedging basically just means that we as the market maker buy or sell delta units of the underlying stock. Now, what happens is that this delta here actually depends on the price of the underlying stock. So if the price of the stock moves, so does our delta. We call this convexity. And because of this convexity, we as a market maker have to constantly rebalance our hedging portfolio. So even if at a given point in time, we are locally immune to changes in the price of the underlying in our options book, if the price then changes by a lot, well, all of a sudden our hedge ratio is off. For example, if we sell a call option to an end customer, what happens is that every time the stock price increases, so does our delta, and we have to buy additional units of the underlying stock. Likewise, if the stock price decreases, so does our delta, and we then have to sell some shares of the stock. And we argue that if these rebalancing activities are large enough, they can have a direct impact on end of day prices or prices during the hedging window. Now, how do we estimate this? This sensitivity of delta to changes in the stock price? Well, it's just the derivative of it with respect to the stock price, which we can calculate, which is gamma. So, we're looking at gamma rebalancing activity here. Now, in order to do so, we kind of need to know about the entire inventory of options that the delta hedger group is holding at any point in time. So for each option, we compute the daily inventory held by different investor groups, and we are interested in this group of delta hedges, which I will get to later, by simply summing up the signed volume in each option contract. Then for each group, the aggregate gamma exposure on a given stock J is simply the gamma weighted sum of the inventories across all options that are written on the stock. So we take the gamma of the option, the inventory that each group holds, and sum over this for all options trading on stock J to get a total gamma amount per group per stock J. And now our assumption is that only broker dealers and market makers actively engage in delta hedging, such that we can define the total gamma amount of this hedger group by the negative of the gamma of customers plus proprietary trading desks plus professional traders. And I will talk a bit more about the data set in a minute. Now, this gives us basically, how much does our delta in the aggregate change for a 1 point change in the underlying stock? But we don't want to have this expressed for a 1 point change in the underlying because we're dealing with a lot of stocks in the cross section and we kind of want to make it comparable across stocks. So through this transformation here, we express it in a 1 percentage point move in the underlying stock. Then we multiply it by the stock by the stock price right before hedging begins to get the whole measure, not in how many delta units will change for a 1% move in the underlying price, but how much dollars will actually have to be traded by the market maker to stay delta neutral. And we then express this relative to the typical amount of trading end of day in that stock. This ADV here is the average dollar volume in the last 30 minutes for stock J. All right, note that we have highlighted that the information about the option inventory and thus the gamma come from last day. So we actually have a clear time separation, right? We never use information from within the hedging window when we relate the rebalancing flows to end of day stock prices. Now this gamma imbalance measures the relative amount delta hedges will have to trade to stay delta neutral for a 1% move in the underlying. Now, this doesn't really tell us the whole story, right? If the underlying stays flat, market makers don't have to do anything, right? They can just sit back. So what we have to do is we have to interact this gamma imbalance with the actual return, with the actual signal that we observe, how much did the underlying move until the hedging window, because we assume that we know when most hedging takes place, to get the total amount of hedging, which we denote as this gamma hedging pressure here. Now, granted, this is of course a noisy proxy. Our inventory data, I will get to this, covers only like about 2/3 of all option trading volume, and we don't really observe changes in inventories intradaily, but it's a pretty good proxy at that. So for leverage ETFs, I will make it brief. What they are is simply a promise to provide a multiple exposure to a benchmark ETF at the close, and this exposure is generally generated using total return swaps, for which the market maker then hedges her exposure by trading in the underlying stock. And the proposed amount of trading for a given stock J due to these rebalancing activities from leverage ETFs then depends on the leverage ratio of the leverage ETF, the assets under management of the leverage ETF, what is stock J's weight in the benchmark index, and importantly, not the return on the underlying stock, but the return on the benchmark ETF. So how much did this actually move? Now, as I've said, this probably requires a lot of data, and it does. We've obtained signed trading volume data on, on individual option contracts trading on all NASDAQ and the CBOEC1 exchange. And this data is then further broken down by the category of the market participants, where we get a reading for broker dealers, proprietary trading desks, public customers, and professionals. And since the option market is in zero net supply, the residual of all of this will then be the trading activity of the market maker. With this, we get information about options on about 3,000 stocks from May 2005 to July 2020, which covers round about 60% of all option contracts transacted on US single equities, at least the options contracts that are exchange traded, of course. We merged this with Optionmetrics, CRISP, and then intraday data by the Trade and Quote database by the NYSE. And for ETF Global, For leverage ETFs, we rely on ETF Global to get all the information, assets under management, the list of all leverage ETFs trading in the US, and all of that. Now, the focus of this talk will be on the joint sample, so all of the empirical results that are to follow, which is the intersection of the two. So we require that each stock included is optionable and included in at least one leverage ETF. In the paper, we also provide evidence for the single samples, which basically confirm the joint sample evidence. So this is the distribution of these two rebalancing activity or rebalancing flows, proposed rebalancing flows over time. And what you can see is that generally the distribution is kind of comparable in its width, but we find that for omega, so the rebalancing amount of leverage ETFs, it kind of co-moves much more, which makes sense, right? Because if we see a large rebalancing amount originating from one leverage ETF, then not only a single stock is impacted by this, as would be the case in the options market, but many hundreds of stocks are impacted at the same time. All right. So to kind of give a more general information than the event studies in the introduction about how large are these effects, we regress in a panel regression the end of day returns on the last half hour, on the return up until the last half hour, our proxy for the rebalancing amount of option market makers and the rebalancing amount of leverage ETF market makers. And given that the gamma and negative gamma would prompt the market maker to buy into the underlying stock, we expect that its coefficient is negative, and the coefficient for leverage ETFs, a positive reading here implies that market makers actually have to buy the stock. We expect this to be positive. And this is what we find. Gamma, the coefficient for gamma here is negative and highly statistically significant. The coefficient for omega is positive and also statistically highly significant. If we consider the two, we can kind of see that the absolute magnitude for both kind of increases a bit. And we can also see that the proposed impact of rebalancing activities from leverage ETFs is about 4 times as large as the one from option market makers. Now, this is kind of hard to grasp. So we have expressed this, in terms of return standard deviations. So I've already said a 1 standard deviation decrease in this gamma, so buying into the underlying, leads to additional end of day returns of 0.7% of the regular standard deviation of returns at the close. For the omega, this number is at 2.7%. And interestingly, because we can actually identify both sources, we can also investigate what happens if both sources agree to either buy or sell into the underlying stock in the last half hour. If we identify only those days, these effects are amplified to about 3% of the return standard deviations. We also employ a trading strategy, which confirms the economic significance. The resulting portfolio that captures these effects is unrelated to any risk factors or the market, and is actually highly profitable, but probably only exploitable for very sophisticated investors. Now, in this talk, I want to focus a bit more about the discussion of these results. In a first step, we validate our assumption of end-of-day rebalancing by simply varying the supposed hedging window from 10 to 10:30 up until 3:30 to 4 p.m., which is the one we use in our baseline case, right? So for each 30-minute interval, we look at what is the resulting impact of these rebalancing flows. When we do this, this is what we find. So for gamma, we can kind of see that the rebalancing flows are at least statistically insignificant up until 3 p.m., where we find a negative coefficient, but which is dwarfed by the coefficient at the end of day. So this suggests that the rebalancing impact is highest in the last 30 minutes, but that also some rebalancing activity may already start an hour before the close. Now, for leverage ETFs, these results are actually stunning, given that the estimated impact is economically and statistically 0 up until this last 30-minute interval, where it is pretty large at like 45-ish, right? So this kind of shows that our assumption that most rebalancing taking place end of day is actually reasonable. but also that at least, option market makers seem to, enjoy some discretion as the timing of the rebalancing flows, and we want to investigate this a bit further. So how can we do this? Well, we simply identify jumps in the underlying stock for gamma, benchmark ETF for the rebalancing amount from leverage ETF, and consider whether there's any rebalancing effects, any measurable impact of these rebalancing flows immediately thereafter. What we find is this right here. On the left-hand side, if we only identify jumps up until noon, under the assumption that the later the jump occurs, the more likely it is for the market maker to wait until end of day to rebalance her exposure, we find a very large and negative and highly statistically significant coefficient here. If we consider jumps up until 2 p.m., this is still, magnitude-wise comparable, but not as statistically significant. And if we then consider all jumps until 3 p.m., right, so very late jumps also, all of a sudden we find that this is not statistically significant anymore. So this is, first evidence for option market makers kind of considering the timing of jumps when deciding whether to rebalance their exposure directly or to wait for the favorable conditions that we have identified at the close. For leverage ETFs, we find that the rebalancing after jumps is virtually zero. So this confirms that they don't really act on their own discretion. Now we analyze this in a bit more detail. What happens on identified jump days for these gamma rebalancing effects, assuming that after the market maker sees a jump, she immediately hedges her gamma exposure, and then at the close only hedges the remaining accrued exposure, right? So after this jump, she's locally immune to changes in the underlying price, and then only at the close hedges the remaining gamma pressure that has built up. What we find is that considering early jumps, this coefficient is not statistically significant. The further we move towards the close, the more significant it is. So this is the second piece of evidence for that option market makers do act on their own discretion by rebalancing after jumps, but only if these jumps occurred early during the day. If they occur later in the day, they will likely wait until this end of day hedging window. All right. We also investigated whether this, relates to trading on information, or as we would hypothesize, this is just, mechanically driven. For option flows, we consider days of fundamental news for each stock, which we identify as earnings announcements, or days where Ravenpack says, okay, we had a lot of information or a lot of news for this stock, and we would expect that the coefficients on these days and the remaining days is kind of the same, and we indeed find this to be the case. For leverage ETFs, we can't really do this, given that a basket of stock is impacted. So instead, we exploit the unique structure of these flows, right? The amount of rebalancing here does not depend on the stock's return, but rather on the return of the benchmark ETF. So what happens on days where the return of the stock J is pretty much zero? Now, if rebalancing is mechanical, we still expect to see a similar impact as before, despite the return on the single stock being zero, but the benchmark ETF can be far from zero. And what this does is it neatly shuts off other intraday return patterns that have been found in the literature. And it also shuts off the impact of gamma flows. So we find that, generally the impact is comparable. Now, in the interest of time, I will skip to the next part of the analysis. Now, given that these flows are mechanical, and if they are large enough to actually drive prices at the close on a target day away from fundamental values, we suspect, or we expect, other market participants to come in the next morning and correct this mispricing, right? So they should reverse, they should vanish from the market relatively quickly. And we actually indeed find this to be the case, right? When we regress the overnight return on these, proxies for the rebalancing amounts, we find that both signs flip, which suggests that, these effects are then reversed. And if we then express it in terms of return standard deviations as before to make it more comparable, we actually find that the impact is highly comparable to that impact that occurred end of day the day before. So in sum, the rebalancing impact is reversed quite quickly. All right. To conclude, we basically show in this paper that rebalancing flows which originate from market makers have a direct influence of end-of-day order flow. Now, I haven't shown it here, but we do in the paper, and returns in single equities. This is all consistent with a non-informational channel. It's mechanical in nature and very short-lived. And we can also provide some evidence that the timing of these flows from option market makers is at least in part discretionary. Now, these results are robust to changes in the empirical design or identification strategy. We can consider different stock subsamples. This is very persistent over the, 9 or 10 years that we can consider these effects. And it's also robust to the definition of delta hedgers, right? So if we only assume that market makers engage in delta hedging, it still works. So that would be from my side, and I'm looking forward to the discussion.
Okay, thank you very much again for this excellent conference, and also for asking me to discuss this paper. The paper addresses a very interesting and current topic given the amount of options trading that is going on these days. And the paper is very well executed, given the time. Clearly, the presentation could only handle very little, but the paper has lots and lots of analysis, which is very carefully done. So let me, given the 15 minutes, let me sort of give you a quick outline of my discussion. I would like to sort of first give the objectives of the study. Again, Heiner has already provided this, so I will go through these things very quickly. Summary of the findings. We'll talk a little bit about options market making and LETF, again, very basic, and then go through some of the variables that are used, how they have calculated, and whether anything different can be done, and sort of tell you a little bit about the prior literature and the contribution of this paper, where this fits in, and then, of course, look at some of the hypotheses, data analysis, and the conclusions. So, there are several things that are being done in this paper, but the main idea is to try and explain the U-shaped pattern people have found in trading volume and volatility, and also the predictability of the last half an hour return using intraday returns. That means the first half an hour return seems to predict last half an hour return very well. But the question is, what is happening in this last half hour, and what are the sort of the basic channels through which this predictability is coming? And that is where I believe this paper contributes a lot. So there are two channels that are being looked at here. One is the gamma that Heiner explained about, which is the hedging by options market maker. And so when they do the delta hedging, the gamma becomes very important. And the other is the ETF rebalancing, which again, given the growth in ETFs, is an important factor. And then, of course, the paper tries to analyze what is the relative importance of these two channels, and whether these effects are more pronounced for small versus large stocks. Again, they have the economic intuition for this and why one or the other might be more important. And then they look at price jumps. Again, what is happening here is delta hedging can only be done if the prices are fairly smooth. When there are jumps, it's very difficult to delta hedge. Because you have jumps and the delta changes very rapidly, and market makers would be unhedged. And then, of course, they look at another important thing, which is the information content of the hedging trades, because this then leads to the price discovery. Where does the price discovery take place? Is it in the options market, stock markets? How does the information in the option gets translated into the stock? And here they find that, again, we can talk about it later, but here they find that the hedging at the last half hour seems to be related to more transient, is related to transient stock price move, and therefore not information related. So let me quickly go through the summary of the findings. So they find a significant relation between the last half hour returns and option market makers gamma and the omega from LETF exposure. And more importantly, the gamma and the omega mostly subsume the pre-period return predictability. That means when you run the regression, the pre-period, in this case, they are using from 1600 hours from time t-1 to 330, the impact is an order of magnitude less. The predictability is reversed in the overnight period. Again, this is very interesting. And as for me, it seems a little counterintuitive, but this is what the result is, that they are finding that this predictability is only transient, that it is reversed in the next day. The option hedging appears to be mostly concentrated in the last half hour. Again, they show this graph by estimating throughout the day. The magnitude of the coefficient of the option hedging variable has increased over time based on rolling regression. Heiner didn't have time to show that graph, but I thought that is very interesting given what is happening over time. There's been a lot more options trading. And then market makers hedge more aggressively following jumps. So this slide just takes you through what the hedging is going on in the options market. In a perfect frictionless market, market makers can hedge their exposure very easily in a continuous fashion. And effectively that gives rise to the Black-Scholes price, because when they are hedging, they are buying high and selling low as the prices change. And this leads to a cost. In a perfect market that given the Black-Scholes assumption, you will get the Black-Scholes price as the transaction cost. But we know markets have a lot of frictions, like the bid-ask spreads, price impact, all sorts of stuff, and therefore hedging has to be done in more imperfect fashion. So some of the strategies are to batch, and in this case, they argue that most of the hedging is being batched at the end because then there is more liquidity at that point. Market makers can use other options on other correlated assets, particularly if they expect jumps. They may have to use other options because they cannot use delta hedging to manage their risk. They can use other portfolios, like hedge portfolio of options using options on portfolios, and just quotes of different options to manage their inventory. And also in this study, they assume that most of the hedging is through delta hedging and takes place during the last half hour. And they provide good evidence for that. The hedging pressure is due to aggregate gamma exposure of market makers, assume that the market maker only does delta hedging. Again, the LETF literature, there's been quite a lot of studies on this, and Cheng and Madhavan argue that this can be also a significant factor at the end of the day, particularly when there's a lot more leverage ETFs being introduced recently. So let me sort of go through quickly the related literature. The study, so the paper provides a fairly detailed literature review, but there are three channels that they talk about, but the most important one, I think, is the intraday patterns with high frequency return momentum by Gao, Han, Lee, and Zhao, and Baltuzan and others. And this is the most closely related paper, I believe. Okay. However, I'm going to sort of tell you what the difference is, how this paper fits in within those papers. The market intraday momentum paper by Gao and others, they look at high frequency ETF data. So they are looking at exchange traded fund. This paper looks at individual stocks. Okay, so that's a big difference here. And this paper focuses on S&P and 10 other actively traded ETFs, and it only looks at the return predictability using past return. So this is only one part of the puzzle. The second paper that I've sort of put up here is a little more closer to this, because they do still look at futures contract on aggregate markets on different contracts like equities, bonds, commodities, and they also find this predictability from intraday predictability, but they also study the effect of gamma and leverage ETFs impact on this hedging and ETF impact on this predictability. So this is sort of the closest paper that I believe to this paper. Now, why is this study important? Again, to give you some idea, you can see the options trading has gone up quite a lot. In fact, if you put 2021, I don't think it's 2020, everything is here, it even probably doubled, okay? And relative to the stock trading, options trading is nearly 2,800% over these 24 years, whereas the stock trading has gone up by about 1,000%, okay? And the other, this is from their paper, they also show that the assets under management for leverage ETFs also gone up from 40 to 120 billion. So they are going to have a much bigger impact in the recent times. So data is very unique because the data can give you, identify the type of traders, and this is being used to calculate the hedging demand, okay? Now, so one of the challenges is the timing, because the gamma that is being estimated is, I believe, based on option metrics. So the option metrics calculates gamma using a binomial model, but using, I believe, the end of day data. So they do have only end of day, but the hedging is going on throughout the day. So how much impact this will have, I'm not sure, but this is what the data is, and they have to use that. So you have to keep that in mind. What can be done, I'm not sure, but the Heiner mentioned that they tried to use the gamma from t-1 to avoid time t, any of the impacts. I'm not sure whether this is good or whether you should use some sort of an average gamma from t-1 to t so that you can capture the intraday gamma. Again, I'll wait for his comments on this. Maybe they have tried some of that. The other is previous studies use the pre-return from 1600 to 10 a.m. In this study, obviously, you need this return up to here so that you can estimate the impact of the order flow for the hedging that is required. Again, if you want to sort of be consistent with the previous studies, in some of the regressions, maybe you want to also study the impact of the time, the pre-return up to 10 a.m. Okay. So other challenges are do not observe gamma for intraday, so need to assume that the gamma exposure at 1530 is gamma from the previous day. And then the idea is to put the stock price as 1530. Now, can you approximate gamma based on stock price at 1530? So the gamma can be calculated if the stock price is given, and if all the other variables like the volatility and maturity, all these are known. I believe that you can calculate the gamma for different stock prices, even though without using the gamma that is given by option metrics. Again, that'll be more work. It's easy for me to say, but the question is how much difference would that make? Now, the gamma is very sensitive to moneyness, maturity, and implied volatilities that are used. Particularly at the money options have very large gamma, so maybe you can do some analysis for at the money versus out of the money option to see how much this might impact your results. LETF rebalancing, this is there is no issues. Now again, this variable R3 is used here, and in the regressions we are using this, but we are also using this R3 as another variable. But I don't think that's going to be an issue. Sort of this becomes more like an interaction of R3 with the rest of this omega and gamma. The signed volume they use, again, I think in the presentation he didn't mention, sort of go through this, but I'm not sure why you are using this method to find the abnormal volume, because what's happening here is you're using volume by an indicator variable, volume during the period when the returns were greater than 0 minus the volume when the returns were less. We're wondering why not just use the Lee and Reddy algorithm to sign, or which in the words already provides the signed trades, and just aggregate the volume. Again, I'll wait for your comments. So summary of the combined sample, the very interesting stuff is median LETF pressure is nearly 3 times that of the option gamma. For example, this is the median number. So your absolute value of gamma for the hedging pressure is 0.21, whereas omega is 0.68. So nearly more than 3. And also the estimates are about 4 times. So the impact of LETF is about 12 times. And also, again, this is probably known, the standard deviation of return in the last half hour is very high, particularly if you look at it in terms of standard deviation per hour. I was a little not sure why you're reporting absolute values here. Why not report the actual? Because most of the gamma, I think, on net, market makers are negative gamma because they are selling call options and they are on net selling puts and calls. And therefore, they are more likely to be negative gamma. And when they are negative gamma, when they are hedging, when the stock price goes up, they have to buy stock. And when they sell, when the stock price goes down, they have to sell stocks. Okay. I believe I have about 3 or 4 minutes left.
1 more minute, Mahen, please.
Okay, so I was going to go through, and so they have already sort of gone through what I was going to again explain from their tables. But so the effect is 4 times for omega and related to gamma. The economic magnitude is going to be 12 times. And then Heiner also went through this. My one comment here would be, these are all individual stocks. Why not use index options also? Because index options are used for different reasons, mostly for hedging. And therefore, you might find, I'm not sure how much volume there is, but believe it is quite high. So let me move on. And they mentioned this again. I have some issues because these numbers are calculated, assume the gamma is going to be the same and they're not moving over time. But let me move on to, they talked about stock price jumps and persistent versus transitory. They did not talk about this, but you can see that the coefficient is much higher in 2020 compared to 2015, -10 versus -20 for the gamma. So in conclusion, the study is very interesting and very carefully executed. The authors provide convincing evidence on the impact of option market making, hedging, and LETF on end-of-day returns. The study also provides several robustness checks which are consistent. Study provides additional insights on the intraday returns and will be very valuable for market participants and for researchers, coming up with models on why we see this type of hedging going on at the end of the day. Finally, I really enjoyed reading the paper and would strongly recommend it to others. Thank you.